A reverse mortgage sounds like free money. No monthly payments, the bank pays you, and you get to stay in your home. But here's what the commercials never show you. From the day you sign, your home equity starts quietly draining away, and it doesn't stop. The loan balance grows every single month, even if you never touch another dollar of it, because the interest and fees pile on top of themselves. Remember the house that could pass to your kids almost tax-free? A reverse mortgage can quietly eat away at that very same equity, year after year. I'm Ray. Today, exactly how a reverse mortgage really works, what it costs, what your heirs actually get, and the honest questions to ask before you ever sign. Quick and important. I'm not a financial advisor, and this is education, not advice. A reverse mortgage is a major personal decision. Always complete the required HUD counseling session and talk to a fee-only fiduciary advisor before you sign anything. Let's start with the mechanics, because it's the opposite of a regular mortgage. With a normal mortgage, you pay the bank every month. With a reverse mortgage, it flips. The bank pays you, either as a lump sum, monthly payments, or a line of credit. You still own the home the entire time. The bank doesn't take the house when you sign. But the home secures the loan, and instead of you paying down a balance, the balance grows because the interest and insurance get added to what you owe every single month. That single flip is the whole story. Let's see who actually qualifies. The federal version, called a HECM, has clear rules for 2026. You, or the younger spouse if you're married, must be at least 62. It has to be your primary home, and lenders check that you can keep up with property taxes, insurance, and upkeep. The federal lending limit for 2026 is $1,249,125. That caps how much of your home's value counts, even on more expensive homes. And before you can even apply, HUD requires a counseling session with an independent approved counselor. That session exists specifically to make sure you understand what you're about to sign. Now here's the part almost nobody explains clearly. Exactly how your equity disappears. You don't pay the interest monthly, it gets added to your loan balance instead. And so does the annual insurance premium. Next month, you owe interest on that bigger number too. That's compounding, and it means your debt doesn't grow in a straight line. It grows faster and faster the longer the loan is open. If your home's value grows slowly, or not at all, the debt can outgrow the home's value over time. This isn't a risk of a bad market. It's just math, built into how the loan works. And before any of that compounding even starts, there are real upfront costs. An upfront insurance premium of 2% of your home's value. On a $500,000 home, that's $10,000. Plus an annual premium of 0.5%, added to your balance every year for as long as the loan is open. Add an origination fee, capped at $6,000, plus appraisal, title, and closing costs. Most of that gets rolled into the loan itself, which means it starts accruing interest from day one too. And there's a rule most people don't expect. In the first year, you generally can't draw more than 60% of your approved amount. The rest becomes available after that. Here's the one genuinely good protection built into these loans. It's called non-recourse. Your heirs will never owe more than the home is worth when it's sold, even if the loan balance has grown bigger than the house. Federal insurance covers the gap. But you won't owe extra is very different from you'll inherit something. If the debt has grown close to the home's value, your kids can walk away clean, but there may be little or nothing left for them. And remember video 16, step up in basis still applies to this house. But it applies to whatever equity is actually left, not the home's full value. A reverse mortgage can quietly shrink the very asset you were counting on to pass along almost tax-free. One more detail that trips people up. What happens to a spouse who isn't on the loan? If your spouse is under 62 and not a co-borrower, she can still be protected as an eligible non-borrowing spouse, allowed to stay in the home after you pass, under what's called a deferral period. But that protection only works if it was properly documented at closing, not added later. She'll also need to keep paying taxes, insurance, and upkeep, and recertify every year. Skip this step at signing, and that protection may not exist at all. Two more things worth 10 minutes of your attention. A reverse mortgage doesn't cancel your property taxes, insurance, or home upkeep. Fall behind on those, or move out for over a year, and the lender can call the loan due and start foreclosure. And this space attracts scammers. Watch for pressure to sign fast, inflated home appraisals, contractors pushing you to fund repairs with a reverse mortgage, or anyone claiming it can save your home from foreclosure in exchange for signing over the title. The mandatory HUD counseling session exists exactly to catch this before you sign. Never skip it, and never let anyone rush you through it. Let's put real numbers on it, using the same house from video 16. At 72, Richard and Martha's approved amount comes to roughly $250,000. Upfront costs run about $19,000, rolled into the loan. In year 1, they draw the maximum allowed, about $150,000. Interest and insurance keep compounding on that balance every year. Illustratively, at typical historical HECM rates, an outstanding balance can roughly double every 9 to 10 years. 10 to 12 years later, that debt can grow past $300,000, more than half the home's value, even if the house never lost a dollar of worth. When Richard and Martha pass, Tom and Susan aren't stuck paying anything extra. That's the non-recourse protection. But instead of inheriting the full $500,000 with a full step-up, they might be left with roughly $200,000. Same house we talked about last time, a very different ending. So here's your action plan. 4 steps. Step 1. Before anything else, get clear on your actual goal. Need monthly cash flow? Want to leave the house to your kids? Those goals can point to very different answers. Step 2. Compare the alternatives first. A HELOC, downsizing, or simply not borrowing against the house at all, especially if leaving equity to your kids matters to you. Step 3. Never skip the HUD counseling session, and never let anyone rush you through signing anything. Step 4. If a spouse under 62 will stay in the home, confirm the non-borrowing spouse protection is documented at closing, not promised, documented. And the usual warning: no legitimate lender pressures you to sign today, and nobody offering to save your home needs you to sign over the title. If something feels rushed, slow down and call HUD directly. If this changed how you think about tapping your home equity, or you know someone considering a reverse mortgage, hit subscribe. I break down one retirement money trap every single week. Tell me in the comments, has anyone in your family looked into a reverse mortgage? I read every one. Next time, turning 65 and think you're covered, the Medicare late enrollment penalty that follows you for life, and the narrow window you can't afford to miss. If you're anywhere near 65, you'll want to see that one before your birthday. I'm Ray. Take care of your money and take care of each other. See you in the next one.